As of the latest market close on Monday, June 22, 2026, the New York Stock Exchange is currently closed, and Nokia stock finished the regular trading session at exactly $14.43 per share, marking a substantial intraday surge of 6.97%. This sharp upward movement caught many retail investors by surprise, especially those monitoring their portfolios through a standard individual brokerage or tracking momentum on various popular investing sites. While the broader public still views this company as a legacy hardware provider or a slow-moving telecommunications utility, the reality playing out on trading floors tells a completely different story. Major institutional firms are aggressively recalibrating their price targets, with JP Morgan recently lifting its projections significantly due to massive unannounced backlogs in optical networks and specialized artificial intelligence infrastructure. This structural shift highlights a fascinating gap between retail perception and institutional reality. While many retail traders are busy looking for the next massive swing in Tesla stock or chasing headlines surrounding Apple stock, sophisticated capital is quietly rotating into infrastructure plays that support the massive data processing demands of the current technological wave. The common narrative surrounding this asset has always been one of missed opportunities and sluggish growth. If you ask the average person using a retail trading app or seeking basic investment help online, they will likely tell you that this company is a relic of the cellular phone boom that lost its crown decades ago and failed to capture the full upside of the initial fifth-generation wireless rollout. Investors who engage in self-investing often looked past it, preferring high-flying tech giants or broad index funds like popular Fidelity ETFs to achieve growth. The general expectation was that this company would remain stuck in a low-margin cyclical loop, forever vulnerable to shifting telecom spending budgets and intense global competition. But the current reality is forcing a complete rethink. The company has quietly pivoted into data center interconnect technologies and advanced optical transport systems, securing massive contracts that are completely separate from traditional telecom cell towers. When a legacy player suddenly secures billions in cloud infrastructure orders, the tension between what the market expects and what the numbers show creates a massive opportunity for mispricing. This recent price action, including the push-up from its multi-year lows toward a recent 52-week high near $17.45, shows that the market is finally adjusting to this under-the-radar turnaround. If you look at the recent trading volumes, more than 111 million shares changed hands in a single session, a clear sign that heavy institutional accumulation is taking place. This is not just retail enthusiasm on a platform like the Robinhood app, it is large-scale repositioning. Portfolio managers utilizing automated tools like Schwab Intelligent Portfolios or setting up long-term allocations via Fidelity mutual funds are recognizing that infrastructure spending has to go somewhere. The massive clusters of graphics processing units that drive modern software require immense bandwidth to talk to each other, and that is precisely where this company's optical technology comes into play. For anyone involved in online investing, watching this volume divergence is critical because it shows that the old thesis of a dying phone company is completely dead. Let us look closely at how this plays out on different trading platforms. A retail trader executing fractional share strategies might completely miss the macroeconomic shifts that an institutional desk notices on an Interactive Brokers platform. Traders who use Interactive Brokers trading services often look at the order book and notice that deep-pocketed buyers are absorbing supply every time the stock dips into the $13 range. This accumulation pattern has been building for months. While retail attention was hyper-focused on the daily volatility of Nvidia stock, this European infrastructure giant was printing higher lows on its daily charts. The shift toward higher margin, recurring software services and advanced deep-field cybersecurity protocols is fundamentally changing the company's financial profile. It is a classic textbook example of why self-investing requires looking beyond household names. True value often hides in the unglamorous layers of the internet infrastructure, where the margins are starting to expand rapidly. Now, I want to take a moment to ask everyone watching a quick question to see where the community stands on this asset. Comment below how many shares of Nokia stock you currently hold in your portfolio, and let me know if you bought them recently, or if you've been holding on to them since the older days of the telecom build-out. Seeing the distribution of retail holdings versus institutional positioning always gives us a clearer picture of market sentiment. To truly understand why the current trend is breaking away from past expectations, we have to look at the underlying business model and how it evolved. The company operates through several core business groups, including mobile networks, network infrastructure, cloud and network services, and an incredibly lucrative licensing division known as Technologies. Historically, the mobile networks division was the main driver, selling antennas and base stations to global telecom carriers. This business was notorious for low pricing power and brutal capital expenditure cycles. However, the network infrastructure division, which focuses on fixed networks, IP routing, and optical networks, has quietly become the crown jewel. By developing proprietary silicon chips designed specifically for high-speed data routing, they have managed to outpace competitors who rely on generic hardware. This proprietary tech is what caught the attention of major cloud service providers, leading to the massive order inflows we are seeing reported today.
This financial transformation is clearly visible when you analyze older reports and compare them to current estimates. For years, the company hovered around a depressed price-to-earnings ratio, often seen as a value trap by those doing research on various investing sites. Cash flow was inconsistent, and the dividend was occasionally suspended to preserve capital. If you look back at the financial performance from a few years ago, the company was struggling with high integration costs and market share losses in key regions like North America. But if you open a modern individual brokerage account and look at the forward-looking metrics on a Fidelity trading platform or a SoFi active investing dashboard, you will see a dramatically improved balance sheet. The company has accumulated a massive net cash position, giving it a buffer that few of its direct peers enjoy. This financial strength allows them to consistently fund research and development, particularly in high-growth areas like advanced photonics and automated network management software, without needing to dilute shareholders or take on high-interest debt. For retail investors who handle their own portfolios through online investing options, the lesson here is all about tracking structural changes rather than matching historical narratives. Many people who use the Robinhood app for Robinhood crypto or casual stock trading tend to treat every legacy company as a permanent loser, assuming that only newer companies can capture growth. But in the infrastructure world, scale, intellectual property, and deep corporate relationships matter immensely. Building a global supply chain that can manufacture and deploy advanced optical transport systems is incredibly difficult. It's not something a startup can do overnight. By leveraging their global footprint and a massive portfolio of patents, they've erected a formidable barrier to entry that is finally translating into sustained earnings power. Looking ahead, the future outlook for this stock depends entirely on whether reality can continue to outpace the market's cautious expectations. There are several key catalysts on the horizon that anyone involved in online investing should monitor closely. First, the expansion of manufacturing capacity for advanced optical components in facilities like Allentown, Pennsylvania, is designed to increase production capacity multiple times over to meet cloud data center demand. Second, ongoing contract wins in emerging markets, such as the large-scale mobile network modernization projects in Southeast Asia, provide a stable baseline of revenue that offsets any potential slowdown in mature markets. If these projects deliver the projected margins, the company's return on invested capital will continue to climb, forcing analysts to adjust their long-term valuation models even higher. However, a balanced approach requires looking at the risks as well. The telecommunications sector remains highly sensitive to macroeconomic pressures, and if global inflation or corporate interest rates spike again, major carriers might defer their next upgrade cycles. Furthermore, geopolitical tensions can complicate international supply chains, particularly for a company that sources components and sells equipment globally. Investors using a SoFi robo-advisor or an automated intelligent portfolio might not see these granular risks reflected in daily algorithmic rebalancing, but anyone engaging in active self-investing needs to weigh these potential headwinds against the current tailwinds. If customer spending slows down significantly, the stock could easily retest its lower support levels around $12 before resuming its upward trajectory. When you manage your assets across different platforms, whether you are utilizing Fidelity investments for long-term wealth management or executing short-term options trades via the Robinhood mobile app, the central theme remains consistency in tracking execution. The stock has spent years in the wilderness, ignored by the mainstream financial media and dismissed by growth investors who were focused exclusively on high-valuation software firms. The reality of the past few weeks has broken that old frame, with price targets moving toward the $20 range for Rachel Materials and solid evidence of data center demand materializing in the financial statements. The stock is showing that it is no longer just a slow-moving dividend play. It is an infrastructure turnaround story that is successfully bridging the gap between old-world hardware and new-world data processing needs. To summarize the core insights we discussed today, the old expectations surrounding this company were built on the memory of its past struggles and a belief that its growth was entirely tied to slowing telecom spending. The reality, as demonstrated by the recent 6.97% jump to $14.43, is that institutional money is moving in because of a massive surge in advanced optical and cloud infrastructure orders. The company's balance sheet is stronger than it has been in years, and its focus on high-margin proprietary network technology is driving a fundamental shift in profitability. While casual market participants continue to overlook it in favor of more popular tech names, the data suggests that this infrastructure turnaround has real legs. Managing this information through your choice of individual brokerage, whether that involves checking metrics on a Fidelity brokerage account, analyzing order flow through interactive broker stock trading, or tracking long-term trends via a sophisticated intelligent portfolio, requires looking past the old labels and focusing strictly on where the capital is flowing. Turnaround stories take time to play out, but when the market narrative finally aligns with improving financial reality, the resulting price movements can be incredibly powerful for those who notice the shift early. Disclaimer. This video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Bags square. Don't forget to like, comment, and share this video to support the channel.